All right. Everybody's going to learn something today. So basically, what we're talking about is The Intelligent Investor. You probably heard of this book before, maybe once or twice, but Warren Buffett says it's by far the best book on investing ever written. So let's take a page from his book, who's earned billions of dollars in markets, and use it in our own trading or investing. In this case, it's more so investing than trading, but you could probably make some good swing trades off this information. In any case, I'm going to break down the pertinent information in this, but first off, who wrote the book? Benjamin Graham. Who is this? Basically, he's known as the father of value in investing. He was making about $500,000 a year before the age of 25, and the market crash of 1929 kind of brought that all down to a halt. He had to rethink his wild speculation and actually become an intelligent investor. So this is widely considered the Bible of value investing, and I'll show you the equation for value investing in this video. So you're actually going to learn the same stuff that they use in their actual own portfolios. Again, he taught Warren Buffett at Columbia. He's also a professor at numerous universities, UCLA and New York Institute of Finance, both very prestigious in the field. But what we're going to take away from this is the Graham number and the formula for the Graham number. And you might be asking yourself, hey, why doesn't everybody use the Graham number? Well, basically, they just don't have the patience to do so. Everyone wants to get rich quick. I mean, what do you think NFTs, cryptos, and all these stupid coins are all about most of these days? I think personally that is probably people trying to get rich quick. But nonetheless, let's take a look at the formula for the Graham number, and I'm going to explain each and every little aspect of it. So first of all, we're going to take the square root of 22.5, and then the earnings per share, and then the book value per share. So this will not work on every particular stock, but it will probably work for most stocks within our metrics. So the Graham number is basically normalized by a factor of 22.5 to represent the ideal PE ratio, which is price to earnings ratio of no more than 15 times. Typically, we want to be anywhere between 5 and 15. If you're one over, one under, you're still probably in the green as far as my book is concerned. And then you have the price to book value of 1.5 times. So how do we get 22.5? Well, that's real simple. We take 15 times that by 1.5, and then we equal 22.5. What is the earnings per share? Well, it's actually the earnings that a stock will have over the course of, let's say, 12 trailing months in this case. So the last 12 months of earnings has yielded $2.21 per share on Ford. And this is a good example because, as you can see, the PE ratios between our 5 and 15 earnings per share are positive, not negative, which is a big thing that this equation will not work on because you cannot take the square root of a negative number. In any case, we also want to look at the book value per share. The equation for this is a little bit more complicated. If you want to look it up in your own time, feel free to do so. But basically, this is going to tell us the assets and liabilities of the company. If the company were to actually go ahead and get acquired by, let's say, Tesla wants to buy Ford, they're going to go ahead and pay the asset price. They're not going to be paying the price per share. They're going to be paying for all the assets of the company because that's what they're acquiring. They're going to pay off all the liabilities, hopefully, and then acquire all the assets. And again, this is based on earnings, assets, and the actual liabilities for the company, as well as the price to earnings ratio of the stock. And then how do we get an actual stock price? Well, that's a good question. I didn't know that for the longest time myself, but now I do. And obviously I want to share it with you. So let's take 2.21 and then multiply that by 6.04, and that should equal roughly about 13.35. Now, the exchange is going to take a small spread on each one of your trades, so you're going to be looking at paying a slight premium, which it's not going to be the end of the world, let's face it, but 13.37 is what we would pay for that share price. So let's go ahead and break out the calculator and start crunching some numbers here. As you can see, I was crunching some beforehand, but we have 10.48, which again was this number right here. And this is all available on finviz.com. So if you guys want to get some cool data all for free, just go on finviz.com. I honestly don't even think that the elite subscription is worth it because all this stuff is available for free. You get a daily chart, you get all this great financial information, you get analyst ratings, all the headlines here. You have stock twits on the right if you actually want to break out the popcorn and have a good laugh. There you go. You get income statements, balance sheets, cash flow. You get insider trading. So, I mean, look, let's see, Ford, 10% owner selling, $188 million worth of stock. Well, that is actually at about the peak. So whoever this was that was a 10% owner really knew what they were doing. So quite interesting. Well, it's actually Ford Motor Corp. They're just liquidating some stock. Hopefully they're going to buy back soon and pump up the price, but that's just my opinion. Now you could see that the earnings were pretty recent. It was October 26th. Today is the 31st. Yes, I have nothing to do on Halloween better than this. So at the end of the day, you're also going to get a good dividend from this. So keep that in mind as well when you're putting your money in here. You could reinvest and buy more shares. But in any case, let's go ahead and circle back to the equation. So we have 10.48, which was this book value per share number right here. And then you have earnings per share, 12 trailing months, which is at 2.21% or 2.21. And then we have as well our magic number, 22.5. So we multiply all this together, you get a real big number, 521. Let's just call it 521.12, just to make things easy. So we get this number here. This doesn't mean much to us. What we need to do here is take the square root of that number, 521.12, and then that will give us 22.828. So let's just call it 22.83. So that means this is the actual price per share that Ford would be trading at if the markets, caught up, if they were to liquidate, essentially like that acquisition thing I was talking about earlier. This is the actual true price per share. So whether it gets there in 2 months or 1 year or 2 years, that's a different story. So that's why you actually want to put your money and invest it into the stock rather than maybe buying some options on the stock, because you could deal with the drawbacks. And in the long term, it will end up at this spot so long as earnings keep up. So let's just take a look. We've got 13.37. So we got a difference of $9.46 per share. So that means you will roughly make about 71%. So that means every $100 you're putting into Ford today will roughly give you about $171 later on, once this all catches up. And how do I know it'll catch up? Well, the math tells us it will catch up. So long as they keep up their earnings, so long as they don't acquire an egregious amount of debt, and so long as nothing really happens fundamentally with the stock or globally, geopolitically, that will cause it to tank. So this is something you want to watch closely. It's not something you really set and forget per se, but you could definitely do that as well, because this time frame for holdings usually will be about 2 to 3 years for myself. You may find your portfolio might benefit from a little different strategy, but honestly, I think that this is quite interesting to look at. And how would you find more stocks that would get into your actual metrics here? So you can go to FinViz, go to the screener section. Personally, I like stocks with large market caps or even mega market caps, because if you are going to do those derivative plays, then you actually have the volume by market cap to do so. You're not going to get really weird off pricing that you can't even sell your options. You can barely even buy it. Just a very ugly situation if that's the case. So let's go here and then go to PE, and then you could actually go low, less than 15. And then what I like to do at this point is just kind of filter it out and go with the largest by market cap. So let's go ahead and take Shell, for example. Oil and gas, good industry right now. So we have a share price right now at $55.63. And then we have 9.5 as the 12 trailing month earnings per share, as well as the PE ratio being within our range. Book value per share is very high, 51.27. I challenge you to try and do this on your own and see where Shell's stock price should be. Now, keep in mind the dividends will lower the stock price every, so often. So that's not a bad thing, because that's money that you're actually going to gain from. And then the earnings was quite recent. So I challenge you to look at Shell, go on finviz.com, do 9.5 times times 22.5, and then times 51.27, and then take the square root of that number and see where Shell stock will be at. Subscribe if you want to see more stuff like this. Like it if you like it, dislike it if you don't like it. In any case, have a great day, and I hope all of you actually benefit from this information. Take care. Bye-bye.